You finally got to the part of the home buying process where you landed a contract on the perfect home. But now you're starting to wonder, is my lender trying to screw me? You're starting to get second thoughts and just wonder what's really going on with those numbers. The good news is the government invented a magical document. The sole purpose in life is to tell you whether your lender is or is not trying to screw you. I'm Matt Wilson, mortgage advisor with New American Funding, and I'm going to tell you how to read your loan estimate. So, what we have here is a sample loan estimate that I found on the CFPB's website so that I didn't have to, accidentally give out anybody's information. Obviously, Michael Jones and Mary Stone at Anywhere Street don't exist. So, that being said, if we look at this is going to have to be sent to you within 3 days of you getting a contract on a house and sending it to the lender. That's 3 business days, not calendar days. So keep that in mind. But that's to keep the ball rolling. In my team's case, we do our best to try to send these out the same day, depending on what time of day you send us a contract, so that you're moving as quick as possible the entire time, because time is of the essence once you get a contract. If it's a 30-day contract, even time rolls quick. Couple things to pay attention to on page one of the loan estimate. Uh, Over here, property address correct. I have seen in the past property addresses be incorrect here. That can be problematic down the road in your loan. So go ahead and look at that now. Sales price, does that look right to you? Um, Make sure that everything sounds like it did whenever you were talking to your real estate agent, so that you know that everything's on the up and up. Loan term, purpose, product, loan type, all that stuff. These should all look like what you talked to your lender about originally. If not, that's definitely a red flag for concern. So pay close attention there. Also, is your interest rate locked? Yes or no? If the interest rate's not locked, pretty much everything in here as far as interest rate related things are going to be just filler to get the disclosures out to you. Hopefully, it's somewhat accurate filler, though. In my case, I do not lock ahead of you signing your original loan disclosure, because I've had situations in the past where people delayed on signing and it cost us closing, and it cost them lock fees because we locked for too short a frame of time. So, anyway, make sure that you pay attention there. But what happens in my loan process is, once you've done the original disclosures like this, we talk through your lock options as they currently are, and then you get a second one of these that shows that it's locked. Um, all right. So then you'll have your loan amount, your interest rate, your monthly payment. The interest rate, again, does not matter if it doesn't say locked up here and marked yes. And haha, I wish this was something that existed today, but obviously this is an older document. So yeah, maybe when you're watching this in the future, these are interest rates that are reality. And if so, I'm sure all of our lives are a little bit better. Okay, prepayment penalty. You'll see that there on every loan estimate. That being said, most all loans do not have a prepayment penalty. This was back in the good old days. This one clearly does. For the most part, if you have a prepayment penalty, it's only going to be on like investment properties or commercial properties or something like that. Balloon payments mean that your loan is going to expire before you've actually paid it off. So, for example, you're paying smaller payments and it balloons in 10 years. Um, that means that you've got to pay it off or refinance it in 10 years. Those are not loans that are very popular anymore, but I'm sure there's still a few out there somewhere if you look hard enough. All right. This part right here, the projected payments, I see people get confused all the time. And it's because, shocker, the government designed this. So the formatting kind of sucks. All right. So, what it's going to show you here is the first 7 years, you're going to have a payment of $1,050, and that is made up of your principal and interest that you saw on the first page, plus mortgage insurance, plus estimated escrow. The thing with mortgage insurance is that's going to vary. Mortgage insurance doesn't lock in until the loan's closed, but your DTI can change that. The property address can change that. Your credit score can change that. So, biggest thing that happens sometimes is your DTI floats around a little bit through the loan process, because we don't know how much your taxes and insurance really are yet, which leads me to the next point. Estimated escrow is estimated. So, keep that in mind. It's not going to be the be all end all, because we don't even know what your taxes that are included in that are going to be just yet in most cases. All right. In this case, it's got years 8 through 30, because after year 8, we're dropping off the mortgage insurance and the payment goes down. So that's why it's got it broken down this way. If you're doing adjustable rate mortgage, it's going to show you things like that too, to show you kind of like worst case scenarios and all of that. Now, here's the part that people get confused on. Below the total payment here, it's got estimated taxes, insurance, and assessments. Well, sometimes I'll have people call me and they're trying to add this to this. The thing is, it's already been added here up top. So all this is showing you is that inside your $206 a month is your property taxes and homeowner's insurance. In escrow, yes. Sometimes you'll see that maybe one or the other isn't escrowed for whatever reason. Don't know why you would, but sometimes it happens. All right. So Estimated closing costs. It's going to give you a total of everything we're about to go into next. Closing costs are the cost of doing business and closing on your loan. The estimated cash to close is something that you really need to pay attention to. So, what cash to close is versus closing costs versus down payment is this: the relationship is your closing costs plus your down payment equal your cash to close. Cash to close is how much money, whenever you get to the closing table, you're going to actually have to either wire in, write a check for. Don't drop cash. It's not literally cash. Cash is not acceptable on mortgage. Now we got that out of the way. But that's more or less what you're looking at there. All right, scrolling to the next page. This right here is arguably the most important page of knowing whether or not you're getting screwed. So on this page, you've got it broken down in various sections that we're going to vet out just a little bit more in detail here in just a minute. But the first section is your origination charges. Thing to understand here is that most of the things on this page cannot go higher than they are if it's something that you cannot shop for. So, for example, your lender is probably going to have some kind of underwriting fee, application fee, lender fee, whatever, origination fee. It's all the same thing. It's there so that we can cover the costs of paying the underwriters, processors, and that like that are touching the file. The points are going to be based on whatever pricing you discuss, based on the interest rates that you've discussed. So that is going to fluctuate if the interest rate is not locked yet. If the interest rate's already locked, what you see is what you get. That being said, your application fee, your underwriting fee, things like that cannot go up from what you see here. Moving around. Also, this is the one section out of the entire loan estimate that's totally up to the lender. Other than interest rates being what interest rates are to a certain extent. So with that being said, that's the spot that you want to pay the most attention to whenever you get into doing uh, whenever you get into shopping and such. All right, so services you can't shop for. These are going to be service providers that help with getting the mortgage done that there's just no reasonable way for you to go shopping for. For example, the lender has to order the appraisal. Spoiler alert, some of these fees are a little more expensive these days because inflation, so here you go. But appraisal fee, you'll usually pay your appraisal up front. So eventually that gets credited back to you. But we have to show you roughly how much that's going to cost on the front end. We try to overshoot on all these fees, but sometimes we miss. There's a slight tolerance cure that's allowed for there. Credit report fee, that's how much we have to pay to get your credit report. So that you have to pay it. Flood determination and monitoring is now just kind of rolled together, at least in my closing cost, into a flood certificate. What that is to make sure that flood insurance is not required for your property, because it is. If it is, then your insurance bill is probably going to be a lot higher than you thought it was, by usually about double. And it's a FEMA requirement that before you can close the loan, we have to have flood insurance involved. All right. Moving around to section C. I don't really see pest inspection fees and closing costs anymore. That's usually just something that happens outside of this. Surveys are something that some states require on every transaction. Tennessee is not one of those. Title insurance is, let me just break down the title company's role altogether, because most people have no idea what the title company does. They're kind of like the ghost of the transaction, so to speak. So in reality, the title company has like three primary functions. The first function is making sure that the property is completely yours. The second function is helping you sign for the property. And the third function is making sure that the money that is associated with the property all makes it to the appropriate parties. So, as far as making sure the property is completely yours, you'll see title policy in here and binders and title search and stuff like that. To make sure the property is completely yours, they're researching the history of the chain of title for the property. Unlike a car where you like carry the title with you or whatever, there's a register of deeds book that happens in basically every county or parish or what have you in your state across the country. And that's the historic record of who's owned that property and who it belongs to. The thing is, you've got things like people die along the way, people forget to pay contractors along the way, people have tax bills along the way and things like that that may pop up and bite you. If you buy the property, it'd be like buying a property or a car with a rebuilt title. And, those problems come along with it. Same thing here. So they're working to make sure that all those issues are resolved. If you get title insurance on it and one of those issues pops up later, then They're pre-resolved for you because you have title insurance. So that's the whole purpose of that. Now, as far as the whole signing documents thing, the title companies who also host that side of things. So they're going to be the notaries that sit there with you and watch you sign a gazillion different papers and make the property yours. And then we all, like, you send your money to title, we send the money for the loan to title, and then title takes that money and distributes it out amongst the different places it belongs, like the sellers and the agents and whatnot. So that's what you're paying for within that. Typically, you and your agent are going to pick out, if you're shopping, are going to pick out what title company you're using there. All right. So D, section D is a confusing section because a lot of people think, oh, we're adding $5,600 in just random baloney here. And in reality, what that $5,600 is everything in the first column added together in a subtotal because, government logic, why not? All right, second column, other costs, government fees. It doesn't matter who your lender is, government fees are government fees. It's not going to charge you any different because taxes are taxes. Uncle Sam's always going to get his piece. Don't confuse these taxes and recording fees and stuff with your property taxes. This is one time that happens whenever you do the mortgage or do a purchase. Property taxes are paid annually. Yeah, you're getting railed, lots of taxes, tax. But that's what we live in. So there you go. All right. So prepaids. Prepaids are there to make sure that, for example, you've got your insurance taken care of and taxes taken care of for the foreseeable future. So usually what you'll see in the homeowners insurance is 12 months here because you're going to prepay for the first year of insurance, especially if you're escrowing. Then you'll have the mortgage insurance. If you have any, there may be a prepayment there that's required for a month or so. Prepaid interest, that is calculated by taking the daily interest and looking at the remaining days in the month. The reason this happens is if your closing date was to be on, say, May 15th, well, there are 16 more days in the month. So you'd have to pay 16 days of prepaid interest because you're not paying your first payment on June 1st. In the May 15th example, you're paying your first payment on July 1st. So you're kind of skipping a month and a half there. So that's how that interest gets made up for that little bit of time delay until your first payment is actually made. Property taxes are prorated down to whenever they're due. For example, in Tennessee, most counties property taxes are due in December. So if it's June, you got 6 months of property taxes left. That's how that works. All right. Initial escrow payments at closing. This is slightly different than prepaids. So this right here is to set up the actual escrow account. Your prepaids are covering you for the next year. The escrow account is collecting money to cover you next year. Even though you're paying escrow monthly, you're stacking up money in your escrow account so that it can be paid in a lump sum for taxes next year and a lump sum for insurance next year. Taxes are going to be whenever taxes are due in your jurisdiction. Insurance is due generally on the anniversary of whenever you got that insurance, or in this case, when you closed on the loan and buying the property. So, all that to say, they're going to keep a little buffer there. Typically, it's 2 to 3 months. If you're skipping 1 month's payment, then it's going to be 2 months there. If you're skipping basically like the 2 month situation, kind of like we talked about earlier, then it's going to be 3 months there because you got to have one buffer month plus make up for the 2 months that you ain't making payments. Similar thing applies to property taxes there, so I won't beat that dead horse. All right, so other owner's title policy. So in section C, services you can shop for, you saw the lender's title policy. The difference in owners and lenders is lenders covers me, owners covers you. That's basically it right there. It's totally optional for you to buy owner's title. However, the thing is if one of those liens pops up down the road, it's only going to cover things that are related to the loan. It's not going to cover anything for you. So it's something that I personally would highly recommend that you do purchase as part of the transaction because crap does happen there. All right. Now, for I, we have another subtotal. We're not adding this again. It's just this stuff subtotaled again because, government logic yet again. For J, for some reason, as if it wasn't confusing enough, we've got another subtotal that's D plus I. Why they couldn't do this in a more straightforward fashion is beyond me, but here we are. All right. So, calculating the cash to close, this is something to definitely pay attention to make sure it's set up correctly for your scenario. The total closing costs are going to be all of this crap we just talked about added together for your specific deal. Closing costs financed are going to be like if you've got down payment assistance or something that's helping you roll some closing costs in. That's very specific scenarios, typically first time home buyer type stuff. Down payment funds, that's going to be how much money do you have to put down? That's going to vary depending on your loan setup and program and what you were doing to start with. All right. Then down payment fund, deposit. That's going to be if you made a escrow, or not escrow, God bless, an earnest money payment. Put the money in escrow. There we go. At the beginning of the transaction. Typically, it's not going to quite be $10,000, but sometimes it will. But that money is subtracted by your cash to close because you already paid it. Funds for borrowers not something you're typically going to see, but it is like if there's any sort of like credits or things like that given, that's kind of how one of the ways that can be accounted for. Seller credits are like if the seller's paying any closing costs for you or something like that. That's where that's accounted for. Adjustments and other credits, I typically don't see at the beginning stages of things because we don't know what those are going to be yet. But those are typically done at towards the tail end, like once you know that the how much taxes the seller has to pay and things like that. All that totals up to your estimated cash to close. Keep this number in mind. Make sure you know that number because that number is a number you're still going to have to come up with whenever you get to closing. And if you've got issues with it, we need to know now. All right. Additional information about the loan. This is page 3. Honestly, this is the page that I get asked the least questions about, but since we're here, we'll go over it anyway. So, in 5 years in this particular loan scenario, you would pay $56,582 if you made minimum payments in principal, interest, tax, and insurance, mortgage insurance, all the stuff. In 5 years, you would have paid $15,000 in principal as well. So, first 5 years or so, it's definitely heavily stacked on the interest side of things, but you're counting on equity gains anyway. Annual percentage rate or APR, that's going to always be higher than your interest rate because it includes the fees that are required for getting a loan. So, for example, points, lender cost, appraisal, stuff like that. Anything that's not a fee that would be required, like for just a loan, but would be there if you paid cash for the house, like some of the title fees and things like that, the taxes and whatnot. Those are not included in APR because those are fees that have nothing to do with you getting a mortgage. They'd be there anyway. APR was designed as a way to help. Uh, it was designed as a way to help compare loan options, but I don't know that it's actually that effective. I'll get into that in another video. If down the road, once I get that video done, then you'll see that video link to click above. All right. Total interest percentage is how much interest you're actually paying in a percentage amount of the loan over time if you make minimum payments. So in this case, you pay 69% of the total loan amount in interest towards the loan. All right. So other considerations, appraisal. You're probably going to have to pay for an appraisal. Even if the loan doesn't close, you got to pay for it. That's because sometimes it's the appraisal that kills the deal, and you can't get an appraiser to go do their job if they don't get paid for it. Because why would you? All right, loan assumption. That's something that's really only going to apply to government type loans. Government loans are the alphabet soup loans. So VA, USDA, FHA, stuff like that. That's your government loans. In a lot of cases, they are allowed to be assumed, which means somebody else can take over the loan. The thing about loan assumptions is we all know what they say about assuming things. And a lot of the times it's like finding a needle in a haystack to find a property that you can purchase and actually qualify to assume. Because, for example, if they bought the house for $200,000 a couple years back and now it's a $300,000 property that they're selling you, then they owe a little less than 200,000, I assume. Haha. And you're going to have to come up with the difference of that $100,000 and whatever. So, with that being the case, that probably not a reasonable thing, but sorry for the tangent. Homeowners insurance, obviously, we want to make sure that if the house burns down or gets flooded or something, that it's covered because we have the lion's share of the money in the house at this stage. So that's what that is. Late payments. Basically, every mortgage I've ever seen has a 15-day late charge, and it's 5%, give or take. I mean, that's pretty standard practice for it to look that way. But there's no late charges for almost any mortgage that I have seen up to day 14. Refinancing. You know, obviously you have to qualify to refinance at the time of the refinance. We can't just refinance the loan just because you want to. I mean, you can't, that still loan practices, loan procedures and policies have to be followed at that stage. All right. So servicing, this is where we'll tell you whether or not we plan to keep the loan. My company, for the most part, keeps the loans. That just means we're the ones that's taking your payment over time. Sometimes there are reasons why we may want to do it with somebody else. Maybe a specific loan product out there for a specific niche, in which case we're going to use that. It may be that, there's another lender that really likes your scenario that we've got access to. I'll send you there because why make you pay more? But that's going to tell you the intent there. That's not the be all end all. It can change over time just depending on what happens. Whoa. So if you made it to this part of the video, you must be very dedicated to understanding the ins and outs of the numbers of your mortgage. If you've already made it to this point, it probably means that you already have a loan in process somewhere. But if you would like somebody to take a second look at it, I am more than happy to. We can have a conversation. You can schedule it in the link below. And it's not too late to go ahead and download your free copy of my ebook, How to Make Getting a Mortgage Not Suck. That way, as you go through this process, it doesn't suck.